as I was preparing the live stream, right, to share with you guys how to manage a bear market, right? Because this is my fourth. Is it my fourth? Yeah. Yeah, my fourth. Okay, my fourth bear market. Okay, and as I was doing that, I noticed, hey, Jerome Powell, because I was reading Binance News, and I realized, hey, the Federal Reserve, led by Jerome Powell, is going to be holding a closed door meeting to discuss, right, interest rate today, right? So honestly, I don't know if this is a scheduled meeting or is this like a last minute meeting. From what I can read, it seems like a scheduled meeting. Okay, so if it's a scheduled meeting, then I think there's nothing too, amazing about it, right? It's just a scheduled meeting. But if it's a last minute arranged meeting, then hey, that could be something interesting, right? We might be having potentially, what Donald Trump has always been wanting to happen is to force Jerome Powell's hand to lower interest rate. Okay, now while I don't think by crashing the market is the best way to do it, but nevertheless, if that's the way he want to get it done, we are just the observer. We just have to adapt to the situation. Okay. All right, so let's start tonight's session. I just want this session to be like a clinic session. For those of you, if this is your first rodeo in the crisis, right? Okay, so maybe as a start for all of you, maybe type in the chat, right? Okay. Uh, how many times have you been through a bear market? Okay, this is my fourth, right? This is my fourth. So later I'll go through with you how did the four bear market affect me and what are the lessons that I learned from it. But right now, how many have you been? Okay, so for definition's sake, it is when from the top to the bottom it fell by more than 20%. So that is the definition, okay, of a bear market, right? So for example, if you look at 2022, right, we had a bear market, right? So from 2022, we fell all the way to about 27%. Okay. Oh yeah, I'm not sharing screen yet. Let me do that. Okay. All right. So this is it, right? So this is the 2022 crash. We fell by 27%. So that was a big one. Okay. As Donald Trump always says, this is a big one. Okay, that's a very poor impersonation. Okay. The another recent one is COVID, where COVID it fell by 35%. Okay. Right. And then we had a mini one, a mini one. Okay. Not is this considered? Yeah, almost almost. I consider this as a mini one. I don't really consider it as a full recession because it fell to 20.19 and then recovered. Okay. So if you count this, then this is my fifth. Okay. But these are those are the two plus the recent one, the third. Then when is my first one? My first one actually goes way, way, way back. Okay. So how far back is actually during the 2008 crisis where it had a whopping, okay, I don't know if you all guys remember, from top to bottom, right, peak to trough, it was a 58-57% dip, depending on where you draw the line, but it's around that 57-58% dip. And it was a very long drawn pullback because the whole pullback itself took over a year, right? 550 days, right? So it's like a year plus, almost like a 2 years duration for pullback. So it was a very painful pullback because if you can see along the way, there was a lot of dip and then recover deep and then recover deep and then recover deep and then recover. So there was a lot of what we call is this called bull trap, right? Where it traps people into thinking that the market is recovering. And that comes the definition of a dead cat bounce. When the market is going up and then it's coming down, going up and then it's coming down. Yeah, it's like a torture, right? Like what Celine is saying. Okay. So for me, 2008. Okay, so let me just share very quickly my experience with the crisis, right? 2008, back then I was pretty young. I was still in university. Okay, so you roughly know my age now. Okay. So I was not that savvy yet. Initially, I was just invested in the market, buying the index and standard stuff. And guess what? Did I hold through the whole period? Did I hold through the whole duration and then come out, wow, victorious and everything? No, I didn't. Okay. So I sold out somewhere. I still remember I sold out close to the year end of 2028, somewhere around here. So in fact, wow, I was like the anti-Warren Buffett. I was so good at picking the bottom, right? But I exited at the lowest point possible. So that was a very, very painful lesson for me because not just that I exited at the lowest point and suffered the most losses. At the same time, after you have suffered such a big drop down and then you suddenly surrender, right? Guess what? Subsequently, when the market recovers, right, I was in no mood to join in. I was in no mood to invest again. Why? Why do you think that I was in no mood? Right? I already saw the market recover, you know. Okay. It went up to about 1,200, 1,300 points, right? And then it pulled back a bit. But I was not in the mood to join in. In fact, I did not buy in at all. What's the reason? Okay. All right. Let me just look at some of your comments here. So I see most of you are two. Most of you are two. Right? Okay, so you are pretty new to the market. That's fine, right? So the latest two, I assume, right? Latest two, huh? Okay. Lai Ling says zero. Wow, Lai Ling, this is your first time, right? You are giving your first time to us. Okay, joke aside, but if it's your first time, great. Right. So tonight I want to make this a session, right, whereby I can help as many of you, right, to navigate this process. So being a four-time champion, okay, four-time champion, as I've been through it 4 times or 5 times, right? I've been through the draw now, I've been through the upswing, right? So right now, I'm quite zen already. I'm like the monk already. Okay. Okay. So let's see. Okay, so some of you are saying fearful, disappointed, right? Yes, BK, you got it. So everyone, can you look at BK's answer? So BK is saying because the prices are higher than when I sold it. Okay? And that was the very basic reason, right? So this is why I generally do not encourage people, right, to try to pick the bottom and say, hey, Pete, the market is crashing, right? You believe the market is going to crash some more, right? Why don't we sell out now? And then when it dips deeper, let me just buy it back later on. Okay? Now, in theory, this sounds great, but I can tell you on the execution end, it is very tough to execute. Why? Because if you sold at, let's say, okay, so let's say the market is coming down. If you sold at here, right, $100, and if it fell to 90, your instinct will be that, hey, wow, thankfully I did not. Sorry, you sold at 100, right? Okay, and it fell to 90, you'll be thinking, wow, thankfully, right? I already sold at 100. But right now, the momentum seems like it is very high. It seems like it's going to continue to fall some more. So therefore, you will not be thinking about buying in. You'll be thinking that, hey, this is going to continue. It's just going to dip further. Let me wait a while more. But even as the prices starts to increase, you'll be a bit reluctant to buy. Why? Because there will be a thinking called a dead cat bounce, right? Remember I told you just now? Where the stock market keep bouncing, dropping and bouncing, dropping and bouncing. So you might be thinking that, hey, this is just a repeat of what has happened, right? Because you experienced it yourself. To the point when it went above 100, then what is the mentality shift, right? The mentality shift starts to think of it as, hey, I sold it at 100. Now it's 110. I can't possibly buy it back, right? I'll be so silly. I will just wait for it to come back down to 100. But guess what? What if, and many, many times that's the case, right? It doesn't come back to 100. It will come back to 103, 104, 102, and then just keep on going up and going up. It's just exactly what happens here, right? Because on the uptrend, guess what? You're start going to see higher highs, higher lows, higher highs, higher lows, right? So the prices, while it will have a little bit of pullback, okay, it's getting a bit messy here. Let me just delete, okay? While the prices will have a little bit of pullback, but you can see it never quite pull back to the previous low, right? Never quite do so. So therefore, once you missed it, psychologically, it becomes very, very hard to buy in. And as the price goes further and further, the more unwilling you are to buy in, right? And by the time you are willing to buy in, the price will have already gone even beyond the previous high rate, right? So to me, that was the main experience I got from 2008, right? That was the main thing, whereby you just need to ignore your emotions and ask yourself, right? I think I've said this many, many times. It becomes a bit cliche, it becomes a bit naggy, but I think it's worth repeating, right? Are you truly investing or are you trading, right? For those of you who saw my TikTok video earlier on, I was just talking about this to the Business Times podcast, right? Because they were asking me, how do you structure your portfolio in this environment? Is it still a 60-40 portfolio? And I said, it doesn't matter whether it's 60-40, it is about whether you will hold a 60-40 through the crisis, through the recession, right? Or through the bear market in this case. Okay, so that was the main lesson I had. And very thankful. I met a lot of people along the way that taught me how to think of investing differently, and that shapes my investing experience from then on. Okay, all right. So that was 2008. Okay. Oh, what happened to my screen? Okay. So, right. So let's fast forward to 2020, right, when it was COVID. Okay. Now this was a very different experience. Whereby the previous time we saw that the market took a dip and then up and then dip and then up and then dip and then up. For COVID, it was like my first time experiencing something that can fall so rapidly, right? Almost a vertical drop, right? How many percent? Let's go and take a look over here. Okay, so this is a whopping 37% drop in a matter of weeks, right? Overall, I think it was 31 days. It fell by 37%. So we reached the bear market very, very quickly. There was no breather at all, right? So even if I go to daily chart, you can see that quite clearly. Oh, where is that? Okay, let me just bring back the chart. Okay, 2021. Okay, yeah. So you can see overall, it moved very quickly. There wasn't much, respite at all, right? At most, I remember there was one bounce. Yeah, over here. Okay, so there was one bounce that bounced towards the 200 moving average, and then it just gave way and then just break down all the way, right? So this was my first time experiencing something that happened so rapidly without any, emotions. And honestly, this is perhaps the best investment opportunity, right? This is the best kind of crisis that you want, the best bear market. Why? Because it just happens so rapidly that it gives you no time to react. Okay, by the time I go around to reacting, right, we were already somewhere along the middle already. So it becomes a lot easier for me, another half a month, suddenly the price starts to go up. And that's when the buying activity starts again. Right. So this is when I truly appreciate a vertical dip, a very, very rapid dip down actually is much more easier to swallow psychologically, right? Although it's a shock and awe initially, but it is much easier to handle because you don't have to drag out the pain, right? Like some of you mentioned the torture, right? The torture of holding on to the asset for so long, okay? Right? And then comes the 2022, right? So during this period, I was already a seasoned crisis bear market well battered person, right? Okay, so I was being tortured enough, right? So this reminds me very very much like the year 2008. When the market go up, down, 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 down. Okay, so it took us almost like 9 months before we reached the bottom over here, before it starts to recover, right? So how do I manage this? It's very simple. I don't know which of this bounce, which of this dip is going to be the last bounce or the last dip. And so basically, I told myself, whatever I've already bought, if it's a great business, I keep. If it's a bad business, let's just cut at whatever bounce there are. Okay. So this is important, guys. Now, what we see is a very fast dip. Okay. Every time after a very fast dip, okay, there will be a relief rally momentarily, even. Okay. So you can see over here, right? So over here, can you see after a very big dip, okay, right? We will have a relief rally. It might not be the full recovery. There will be a relief rally, but my position doesn't change. My method doesn't change. I still keep my good companies that I hold on to, and the poor companies that I have, I use the opportunity of the rally to get rid of it. Okay. Now, this is very crucial. Why? Because a lot of new investors, what happens is during the relief rally, guys, let me ask you, during the relief rally, do you think the good company will jump the fastest or the speculative but not so good company will jump the fastest? Which one? What do you think? Is it the G or the S? The good company or the speculative company? Okay, type in the chat. Jump the fastest. On the relief rally, do you think the good company will jump the fastest or the speculative company will jump the fastest? Okay, so I see a lot of G, I see a lot of S's. Okay, now for those of you who say the good company will jump the fastest, please hold on to that belief. Don't change. Okay, but the thing is this: I can tell you during the relief rally, the speculative stuff will jump the fastest. Why? Because the speculative companies will attract the lousy trash retail investment again, right? For those who invested in those speculative businesses, now when the index starting to run, guess what? The money will flock back into all these again. Okay, they are like magnet. They are like what do you call it? A moth to fire. Okay. But that is also the best time for you to offload such lousy companies. Okay. So do remember that. Regardless whether the upcoming relief rally, which it will happen, it is inevitable, it will happen. Whether is it a relief rally or is it just a start of a continuation of a full rally, you need to get rid of the speculative business. Because if you don't get rid of speculative businesses, and some of you might even add on to it, when the subsequent proper pullback happen, it is going to destroy the portfolio. Okay, I say this with a very heavy heart because I've seen this happen in some of my very long time friends, but they are just so knee deep, or waist deep in the trading game, right? They cannot pull themselves out. Okay. And guys, I want to emphasize this period is not a heaven for trading. If you are trading, you need to be very good at it. You may need to be top of your game. Otherwise, you're probably better off just looking at investing, buying it into good business when it's cheaper, and selling off whatever bad business you hold in your portfolio when the bounce happens. Okay? Because even if the bounce happen, let's say it's in this period, and then you saw the relief rally, right? If you sell away the speculative business, good news is that as it continues to run, in the long run, the good business will outrun the speculative one. But in the short term, the speculative outrun the good business. Okay? All right. So that is one thing that you need to take note of. And that's what I observed during the 2022, right? Because on the speculative run, you will see companies like Zoom. Do you still remember? Palantir. They actually jump, the one night they can jump 10%, 12%, C limited, right? Easily jump 8% overnight whenever there's a relief rally. But subsequently, they all continue to fade away. Okay, so just be very mindful of that, right? So where are we right now? So let's go back to the chart. Okay, so let's take a look. Let me just type in the 1 year. Okay, so here we are, right? We are actually at the point that is very similar. I don't know whether y'all can see the similarity towards the COVID period, whereby we had a dip below the 200-day moving average. We bounced on it. We failed the 200 moving average. This is considered like a second bounce, and then we just had a parabolic drop. Okay, right? And my current thinking, my own prediction, although I keep telling everyone that try not to time the market, but I know that a lot of you out there need some bit of guidance, right? Okay. To me, is that I think there might be a bit more room to go. Okay. Why? Because we don't see the prices consolidating yet. Right? We don't see the prices consolidating. What do I mean by consolidating? That means the candlestick stop dropping so rapidly, like it gaps down, but it's so long and thick. Okay. Right. Let me just zoom this bigger. Right? Okay, right? Where it's so long and thick. I want it to be closer to the. Okay, let me draw this. I want it to be closer to this, right? As it dips down and it doesn't drop so much already, and they don't start to do this. Okay, this look very idealistic now. This is like an ideal drawing, but it should look something like that. Okay, it should look something like that, and I want to see that happen right before I really start to power back into the market. But of course, any form of rally, I'll just take it as an opportunity to scrape away all the lousy businesses. Good news is that right now, I don't really think I hold any bad businesses, right? So for those of you who still hold bad businesses, that's my suggestion to you from a personal experience, right? Surviving through '08, right? 2020, right? 2022, and most recently. Okay? Right. So here we are right now. Now, if the Federal Reserve announcement over here at 11:30 later on, right, were to hold through and they were to lower the interest rate, okay, right, we will see a relief rally and it could be quite strong, maybe even sharper than what I draw here, right? So just remember, when the relief rally happens, it is not time for you to plow in your hard-earned cash, but for you to position yourself for a greater rally, right? Position yourself in what ways? Trim away the bad businesses, right? And if there are any good businesses you want to buy, right, then that's where I will start to buy in. But I will buy in gradually, not power into it, right? I will buy in gradually until when I see a lower low, lower high like this. Okay, so if you go back to the time of 2020, right? Okay, right. Okay, let me just pull back 2020 quickly. Okay, so can you see? Can you see a bit of similarity here? A bit of similarity here. Although the green and the red bar doesn't really coincide perfectly, but can you see there was a gradual drop below 200? We bounce off, and then now we are dropping down. Okay, so now I think we are somewhere here. It looks like we are somewhere here. So could it have fallen a little bit more? Perhaps. But what I want to see is the proper rally, bounce off, head up, bounce off, head up, bounce off, forming the higher high, higher low. The stairs, right? I call it the stairways to heaven, right? Start stepping up to higher prices. All right. Okay. So this is the main thing that I see in the market right now, and I just want to share this with every one of you here. Okay. All right. Now let's look at what are the things. Okay. So let me just go through some of the charts. Sorry, some of the trades. Some of you are talking about synthetic, SMG tracker. Okay. So great, right? Let me just share with you guys what are the companies and how do I look at them. Okay. So let me put on the slideshow here. Okay. Right. So for example, right, in our stock market genius trades, there was one synthetic that I put on for AVGO, okay, at 170, oops, sorry, 170 sell put, okay, and 170 buy call. Now, for those of you who understand synthetic, great. For those of you who don't understand synthetic, please do not use this as the learning of synthetic. We have a full on like a few minutes that I recorded on our program, right, to share with you, teach you exactly what is synthetic. So please watch that. Okay, so I won't take the time to go into the details here, but basically what we are doing here is we are selling put options at 170 for AVGO. That means we are promising to buy shares at this price. Okay, so for that promise, I generated $15, right? And I took that $15 and I plus a little bit, okay, to buy a call option over here, right? And the call option happens to be around 170 as well. So this is called a synthetic position. Basically, it's double bullish, right? You're selling a put, you want the price to stay above this 170. You buy call, you want the price to go above 170. Okay? So now, guys, when you are entering a synthetic, so for all of you here, right, regardless whether you are in SMG or not, one important thing that you must remember as a good investor or as a good trader, regardless, okay, you need to think of your plan, your trade plan, even before you enter the trade. Okay, even before you enter the position. So when you're going to enter a synthetic, what are we thinking through? Okay, so let's go through this one by one. Follow me through. Number one is that since you are selling a put option, you must be willing to own the shares at those prices. That means when I sell AVGO for 170 strike price, I am happy to buy the AVGO at $170. What if I'm not happy to own AVGO at 170? Then I should not be entering this position in the first place. Okay? Make it as simple as possible for yourself, right? So this must be the first premise. Because if you're not willing to own the shares, guess what? Then you are just selling put in chase of the premium, which is scary, which is dangerous. Okay? Number two is this. I notice some of you, when you type in your account number, not account number as in broker number, but you type in your margin amount, it seems to me that some of you might be using margin to execute this. And I just want to emphasize, please do not use margin to execute any trade, including synthetic. Okay? Doesn't matter if you're just selling put options flat or you're buying a call options or you're doing synthetic, please do not use margin. Why? Because especially when you're selling put options, you are accountable for the amount of cash. Okay? So everybody just a practice, for AVGO 170, what is the amount of cash you need to have in your account in order to cover this position? What is the amount of money you need to have to cover this position? For every single one of you who are doing synthetic, I want you to write down this number. Okay, regardless you have used margin or not, it doesn't matter already. What has passed is passed, but I want to remember this lesson from here on. Okay, yes, very good. Is 17,000. So how do we get that? Because every put option is 100 shares. So we're going to add 20 at the back, and that's how you arrive at 17,000. Okay, so if you're going to do this trade, you need to make sure that you at least have 17,000 cash in your account that is not being used for other things, so that you can execute this trade. Okay, if you don't have this amount of money, guys, and you go into the brokerage, will the broker allow you to execute the trade or not? Yes or no? Will the broker still allow you to do it? Type in yes or no. Okay, BK very good. BK says, see how much margin. It's true. Okay, it will. Okay, so Esther say no. Actually, they will. They will allow you to do it so long you have margin. Okay, right? And during the good times, they will give you a lot of margin. Now, guys, let me explain margin to you. Margin is changeable. During the good times, they can give you 50%. In the bad times, they can give you 20%. It's up to the broker to adjust So do not be surprised if you are using margin and then you say, hey, Pete, I only use 20%. Sorry, I only use 30%. How come they're asking for more top up? It's because they lowered the threshold. They make it safer for themselves. Okay, right? So the best thing to do is you want to survive the trade, you want to hold it through, is just not to use the margin at all. That is the best. Okay, that is the best. So don't use margin, right? Okay. But having said that, okay, I know some of you all do use margin. Okay, right. So let me just go through. Okay, let me just go through how to remedy this. Right, how to remedy this. Okay, so imagine you have done this trade already. Okay, so what you can look at right now is if you were to close this position right now, how much would it cost you? Okay. So for example, initially when I sold the put option, it was $15.63. Okay. Now, if today I were to buy it back, same put option at the same expiry date, I will need to pay $24.58. Okay. Let's just ignore the call options for a moment. Okay. Because let's take it as a call option will burn to zero already. Okay. So if I were to do this, right? Okay. If I were to buy this and I sell away this, and don't forget, I paid for the call option some more. If I were to close this whole position right now, I will make a loss of $2,700. 27.33. So $2,733. Okay. Right. So basically, I take this premium that I collected. So I need to pay, right? I minus away what I collected, and I have to add on the cost of the buy call initially. Okay. So this 27.33. So how can you remedy this is, in a way, you kick the can further down the road. Okay. So your expiration date is very soon, is like next in 10 days, right? 17th of April. So what you can potentially do if let's say you don't have the funds to buy the 100 shares yet, you just need to buy some time for you to put in more funds, or you want to buy some time for the share price to increase back. Okay. What you can do right now is if you look at right now at AVGO, the sell put at 165 going into 18 July is selling at 28.28. Okay. So guys, is this enough to cover my losses here? Yes or no? I want to make sure that you all understand the basics of options. Okay. Yes, right? Okay, because you're selling a higher amount to pay back a lower amount. So yes, it covers. So what happens here? Very simple. It basically changes your sell put expiration date from 17th of April to 18th of July. That's all. Okay. So in a way, you are just kicking the can down the road, right? To make sure that you don't get exercised too soon. You just need more time. You want more time for the share price to increase back. Okay. Now, having said that, okay, I just want to emphasize, having said that, what do you think I am doing? I have this trade itself in my portfolio. What do you think I am doing? Okay, right? What do you think I am doing? Okay, so BK says do nothing. Wow, BK know me very well. Okay, right? So guys, why am I not doing anything? Because to me is this. I don't know when the market will recover. Okay, I don't know. I have no idea. Right? So what I want to do is back then when I do it at 170, I already thought that it's pretty cheap. I already thought it's pretty cheap. So what I'm doing right now is okay. By the way, right now AVGO share price about 142. Okay, the market just opened, right? 142. I'm happy to buy 142 first, so that later on when the share price increase, right, way above. Okay, I'm happy to buy at 170. Sorry, 170. So that when the share price increase to 170 and higher, I will be there to take advantage of the increase in price. Okay, rather than I just kick the can down the road, okay? And if the share price shoot up all the way above 165 by July or 170 by July, I don't get anything at all. Okay? So to me is sometimes, yes, I want to protect the downside, but I can tell you in a bear market, while protecting the downside is important, but in my opinion, having the potential to reap the upside is even more important. Do you understand what I'm trying to say? Right? Because the market will recover eventually. And in my opinion, AVGO is a great business. right? Yes, they will be affected by a tariff, but guess what? All the other businesses are also affected by tariff, right? So if everything net equal, okay, right, they will still be the better business out there, right? So I'm happy to hold the shares. Yes, of course, I wish I didn't sell the put in the first place, but it is what it is. So there's no point regretting the past. Okay? So the important thing here is this: it depends on your position preference. For me, I have the funds every time I sell a synthetic or I execute a synthetic, I always make sure I have the funds to cover the position. But if you don't have, would be my suggestion. Okay? Rather than you go into margin and get a margin call, I rather you just kick the can down the road. Maybe you will miss a bit of upside eventually. That is really out of no choice, right? Rather than right now you have to pay up when you don't have the money. Okay? You understand what I'm trying to say? So guys, remember this. Let me just, you know, but again, I want to emphasize again, one more thing is do not use margin on synthetic or in fact on any options trade you're going to do. Okay? Please do not use margin to sell put. Please do not use margin to execute spreads. Don't use margin to buy call options. Okay? Right? My preferred method for synthetic that is already way below the strike price is I want to buy the share, okay, and I want to wait for the price to increase because I don't know when the bounce will take place. It could be 9 April, it could be tonight at whatever timing Jerome Powell had discussion with his own merry man and decided to drop interest rate, right? Or when Trump decided to be sane again, I don't know when, right? But all I know is I don't want to be missing out because if I kick the can down the road, I roll the put down, it's going to lock in my capital. So that means that amount of capital, I can't really use it, right? To buy anything. So I don't get the upside. You get what I'm trying to say? Okay, so that's number one. For those of you who are measuring margin, the main or easiest way for you to measure your margin usage, right, is this. However much cash you have in your account, okay, check against all the sell put positions that you have. So for example, I'm just doing a rapid fire. I have a AVGO 170. Maybe I have something else that's 50. Maybe I have something else that's 80. Okay, imagine all of them are one sell put, and I have another one that's maybe 60. Okay, so guys, can y'all add this up and tell me how much money I need to have in my account? Okay, how much money I need to have in my account to cover this pure cash, not use margin. Okay, so please do not look at things like buying power, excess liquidity. These are all fancy words. It doesn't tell you anything. The one thing that you should look at is what is your cash available. Cash available. Okay, very good. 36. Okay, basically just add up all these numbers. 17 plus 5 is what? 22 plus 8 is 30 plus 6, 36. So 36K. Okay. All right. So you need to have 36K just by executing these trades. Right. If you don't have 36K, whatever number they tell you in like maintenance margin, excess liquidity, or whatever name they use, they are just trying to entice you to use margin. Okay. Right. So that's the easiest way. But if you want to look at excess liquidity for some reason, okay, excess liquidity is the margin that they are lending you. Okay. Right now, I just checked with my IBKR, they are giving you about 30% of your portfolio value. So if let's say you have 1 million, okay, even if you use up 1 million fully, you will see 300K in your excess liquidity. Okay, right? But you don't want to use it at all if you can, right? So please do not mistake excess liquidity as cash available. Very important here. All right. Okay. So right now in let's take a short pause. Let me see you guys have any questions left. Okay. So Glenn says excess liquidity means cash available. No. Excess liquidity is excess liquidity. Check for cash available. If you all need me to find the exact word, I will find the exact word. Yeah. let me let me let me log into the one of my brokerages. Okay. All right. Okay. So you should see cash balances. Okay. I just want to be very exact here. Cash balances, not excess liquidity. I say this again. Not excess liquidity, but cash balances. Right? Because that is the purest. If you buy something, you will definitely take money from there. Right? Okay. So that's the key here. But to be honest, the easiest way is to just count all your put options, add up the strike price, and understand how much you have to lock up for your put options. Okay. All right. Chris is asking, how do you know what strike price to roll to? I don't really have match for it. What I'm doing is very simple. I'm just looking down the chain. Okay, down the chain. Okay, to look for. Okay, maybe I key in the AVGO one to show you. Okay, here. Okay, so I'm just looking down the chain to look for something that can cover my losses. So my losses was 20. Wait, let me just go back again. Was $27. Right. So $2,733. So I'm just looking for something that can cover that. Right. So you can look at 18 July is 2827. So it covers. Right. You want to sell further down, August also can cover, right? But anything beyond that, then you can't really cover. Now, as for strike price, of course, what I want to do is I want to bring down the strike price as much as I can. Okay. So if I can bring it down to 146, right, then you can see that the premium that I collect will drop quite fast. Now it becomes 1,700. So I will still have a loss about $1,000. Now, how do you get $1,000? You probably need to sell something very, very far away. Right. So can you see? I think I can only get it if I sell until next year, right? Which is ridiculous because you might not even want to hold this position until so far in the future, right? So what do you want to do here? Do you want to just have a very low strike price and sell the premium until forever and lock up your funds forever? You can do that, but I'm not an advocate for that, right? So for me, is I'm just happy to kick the can down the road, give myself some time. I drop the strike price by $5, okay? But I stretch the timeline to July, August period, right? So that's how I go through the thought process of choosing. Okay, but having said that, I just want to emphasize again, this is not my preferred option. My preferred option has been to just let the sell put exercise. Okay, right? To just let the sell put exercise, right? Which is why when students ask me like, "Hey Pete, what do you do? Should I sell it, right? Or should I accept the losses, exit, and then re-enter?" To me, actually, synthetic, if you've done it correctly, if you've done it with the correct mindset, the correct approach, you should not have to do that, right? You're just saying, hey, I love this company. I sold it at this strike price, which I thought was pretty cheap already, right? Yes, it fell deeper, but it's okay because back then when I was going to buy it, I was going to buy it at 170, right? So no regrets there, right? In fact, if anything, I still got the premium that I gained from the sell put, right? So that is something that I would prefer to do because I want to own the shares, right? So think about it. You look at this, right? I sold it at 170, right? I use it mostly to buy call options. This call option in the end burned to zero, right? Which is very likely to happen. Okay. Right. So my strike price is 170. So, and I ask myself, hey, do I think that AVGO in the future? Okay, so let's go to the chart. Okay. Do I think that this is a great business? Number one. Right? You first must ask the question whether it's a great business. If you cannot answer this question, then something is wrong. Okay. Right. So, firstly, is it a great business? If it is a great business, right? Ask yourself in the long term, if you just look at weekly chart, right? And if the market were to recover, right, would it be reasonable to say that this price will go above 170? What do you think? Okay. So when I look at it, my personal thinking is okay, maybe the gradient is not like this. Maybe the gradient is like this, right? But you can see even at this slope that is gentler, I will already pass 170 when I hit like maybe October, September period, right? So to me, it's, hey, yeah, I'm happy. I'm happy to own the shares because yes, I may have bought it a bit more expensive now, right? In fact, if anything, after this sell put exercise, I look at my position. If I can add further, I will add. If I can't, so be it. But at least I know that now I have 100 shares of AVGO. When the whole market recovers fully and we go back to AI, we go back to systems training, we go back to AI agents, right? Broadcom will be one of the main beneficiary. That's all. So guys, whenever in doubt, always zoom out. Okay? One of my favorite rhyming phrases. Whenever in doubt, just zoom out and you will be able to see a much clearer picture here. Okay, any more questions now? I hope this is useful and for all of you, right? And I hope this is also calming for all of you, at least to know that somebody like me, right, I've gone through this gauntlet 4 times or even 5 times if I count the other times, right? And I still turn out okay, right? So I want to share with you all my experience. What are my methods? I hope that I can be that been there, done that person for you guys, right? If it crash, don't worry, right? Stay the course. If you buy good business, right, nothing bad can happen to you. And that's what I truly believe. Because if you buy good businesses, right, this is the time where the market is trying to tempt you to sell, right? So for example, guys, I receive some of you the the SMG forum, right? So some of you say, hey Pete, I have 30 Microsoft shares, they are in the red, right? I'm torn between selling them, but I'm bullish. So guys, what should you do? If you feel like selling them because the share price is low, is that a good reason to sell or not, guys? Is that a good reason to sell? No, there's not a good reason to sell unless Microsoft fundamentally deteriorates to zero. Okay? So of course there's no such thing as I buy a stock and I hold forever. Okay, like what Raymond is asking, right? No, Raymond asked a different question, but is there a stock that I will buy and hold forever? There's no such thing, right? I will continue to monitor the fundamentals. If the fundamental change, I change, right? But right now, Microsoft fundamentals is still very strong. Okay? Even as a Mac user, I cannot avoid paying Microsoft to use Office, right? That's how powerful it is. Okay, right? So just remember this, right? And Microsoft is way beyond that, by the way, right? They have a lot of other investment, and one of the strongest investment right now is still ChatGPT, still the strongest. Okay, and once again, guys, when the market prices drop a lot, right, they will want to tempt you, right, to have a mentality of, hey, accepting the defeat here, exit, right, so that you enter again later. But guys, remember, right, the big boys out there is trying to bottom fish your stocks. Please do not sell it to them. Please do not sell it to them. If anything, I want you to follow one of the members here, right? He's saying that, Pete, do you stick by the numbers in your crisis buy list? Then I say, yes, I'm buying in drips. Okay. Then he said, cool. I'm always so tempted to average down, right? So a lot of times, right, guys, I want you all to know, sometimes doing the uncomfortable things like averaging down, right? Okay, if you do it by yourself, it's very uncomfortable. But I hope that in this case, by me sharing my experiences, all right, and my opinion on things, it gives you the feeling of, hey, I'm not alone in this, right? I am also averaging down to buy more, okay? And that's why over here, I say to him, I said, that's good. I wish others feel the same, right? So, guys, I want all of you here to not feel the fear in the market. But right now, when you see there's a lot of blood in the market, right? Think about, hey, what are the things that can I do? How can I go and take advantage of it, right? Tonight, yes, we might be seeing a little bit of a rally, but honestly, will this be like the end all be all? No, this is just one candle of the many, many, many candles ahead of you in the market. Okay, this is definitely not going to be a wow, tonight, that's it, the market finish and just crawl back up here. It will not happen like this, right? There will be a recovery. There may be further dips, right? My personal opinion is that the little dip here may be a relief, but guess what? I'm holding on to my best company. So even if I am wrong, I can still make money. Even if after this, the market does this, and somehow I only manage to sell away the poor businesses and not able to buy more for some reason, I will still be better off than selling at the very first time. Okay? All right. So what's the reason? Let me see. Okay, so Vinci is saying Trump is considering a 90-day pause in the tariff. Voila. Right. You guys, I remember I said this, Trump is probably bluffing, right? So maybe he is. Okay. All right. So Angeline says, Mickey, feel that you are not alone. Exactly. Right. So guys, don't panic. The market has done this many times. I assure you, they will continue to do it again. If you feel very stressed, you can be like me. Just grab a bottle of beer and just watch the show. Okay? All right. Okay, so everybody, I'll just end here. I don't want to drag you guys for too long. I hope this last minute session is hopeful for you guys. To be very frank, I didn't have a lot of time to practice and prepare a lot of things, right? So I'm pretty much speaking off cuff, right? So if there's anything that's a bit unprepared here, I hope you all can forgive me. But the important thing is this, regardless whether you're in SMG or not, right? So long you're in my community, I promise you all, I will guide you all through the process. Okay. But of course, for those of you in SMG, I'll give you a bit more. Okay. So right now, what I'll do is I'll go and buy the crisis buy list stocks already. I'll buy in drips and drabs. Okay. Then for those of you in SMG, go and take a look. See if there's anything you want to buy. Just buy a bit here and there, right? Go and do a bit of shopping. You don't have to buy down the whole grocery aisle, but just can buy something, right? Because things are pretty cheap already. Okay. All right, so that's all I have. Thank you, everybody, and I'll see y'all at the next one. All right, bye bye.